And so we believe we're beginning to see deflationary trends in many more sectors now.
Hello, everyone. We all spend money to buy or pay for something, right? So it's no wonder we're worried when prices of goods and services go up. How about when they come down? Well, something interesting is happening to the economy. Take the egg, for instance. In September this year, the U.S. egg farm price was $1.22 per dozen. A month later, it reduced by 1.64% in October to $1.20 per dozen. A year ago, the egg farm price stood at $2.08. The price dropped by more than 57% in 1 year. Data from the Department of Commerce indicates that as of October this year, prices of consumer goods dropped by an average of 2.2% compared to the previous year. This trend hints at the possibility of an imminent deflation. Shouldn't that be a good thing? Cathie Wood, CEO of Ark Invest, a Florida-based investment management firm, believes that deflation will continue to rise and become even more profound in the coming months.
And so we believe we're beginning to see deflationary trends in many more sectors now. It started with commodities. Now we're seeing airline prices coming down, auto prices coming down, and we're seeing staples prices. They have been sticky, but what's happened to staples volumes? They have gone down. That's not how you run manufacturing plants. So we think that they will be forced into cutting prices.
Cathie hinted that the efforts of the Fed in curbing inflation have gone overboard, saying, "The Feds have overdone it." Should we expect more deflation? Is Cathie right? What could be wrong with deflation? Before we get into that, I would like to give you some background about deflation. Deflation isn't the kind of stuff you hear every day. We're more used to the opposite, inflation. Inflation takes root from the word inflate. That is, to get bigger or rise. When we use the word inflation in economic terms, we refer to the rise in the prices of goods and services.
In 2008, prices in Zimbabwe doubled every 24 hours. The government printed more and more money. Before long, everyone was a trillionaire. Things got so bad that the country ran out of paper to print all the banknotes.
These might happen to any country if inflation is not being monitored, and the government will just print more and more banknotes. Inflation is also present in things that you are used to buying. For example, you bought a cup of coffee for $1 last year, and then this year, you go to the coffee shop only to find out that the price has increased to $1.03. If you do the math, you'll see that the price of a cup of coffee rose by 30%. Deflation is the opposite of this situation. Instead of rising, prices fall. That would be cool, right? Wouldn't you want to pay less for stuff and save some cash? For the past 2 years, we've had to deal with high inflation. Prices of stuff going up like they're heading for the moon. 2019, the inflation rate was 1.81%, a decline of 0.63% from 2018. The inflation rate was reduced further in 2020 by 0.58%. Then, in 2021, the inflation rate got some balls and rose as high as 4.7%, going up by 3.46%. It increased to 8% in 2022, a 3.3% rise from the previous year. Inflation isn't necessarily bad, as it can help steady the economy. However, when it rises rapidly, like in 2021, it will no longer be healthy for the economy. The money you have can't buy as much as it used to. Look at the graph of inflation rate and the graph of US dollar purchasing power. Rising inflation reduces purchasing power because while the currency's value remains, the prices of goods and services increase. And unless your income grows, you'll become poorer. So deflation should be good news for us, right? Deflation has been creeping up on us stealthily and steadily like a thief in the night. A report by David Harrison in the Wall Street Journal gives us a clear picture of this recent trend. According to David, prices of goods have dropped steadily for 5 months as the inflation rate dropped by 2.6%. Now, don't get too excited. According to David's report, this deflation only happens with goods or tangible items. It's not a blanket thing yet. The prices of furniture, appliances, and used cars are dipping steadily, and Cathie thinks it's going to continue. Let's consider the following points. First, the dollar is getting stronger. That means the dollar has more value relative to other currencies, so importation costs are quite lower than before. And what do you think will be the result? You guessed right, lower prices on store shelves, so you're likely spending less on goods than you did before. This trend will continue as long as the dollar grows stronger in the international market. Fortunately, Lombard Odier, the Swiss private banking firm, predicts that the dollar's value will continue to increase relative to other currencies in the coming months. So, let's see another reason why Cathie may be right about deflation coming to stay. Remember, earlier, I mentioned that she said, Fed has overdone it. Keep in mind that the Fed means the Federal Reserve Bank. So what did the Fed do? To explain that, let's talk about monetary policy. Monetary policies aim to control a nation's money supply to ensure economic growth. These actions change as the economy changes so that the country can have the best possible economic outcome at any time. Adjusting the interest rate, bank reserve requirements, and the price of financial assets are some actions that can be taken to manage the economy. The Fed is responsible for managing the monetary policy. So, while we were dealing with high inflation, the Fed got to work, working up some policies to wiggle us out. So what did they do? The Federal Reserve Bank raised interest rates. How does this work? One of the characteristics of inflation is too much money in circulation. So the Fed sought to reduce the money in circulation by increasing interest rates. Here's the theory. With high interest rates, people will borrow less or carry less balance on their credit cards, eventually spending less. This will reduce demand and drive down the price of goods and services. If this drags on for a longer time, deflation will set in. And that's exactly what the Fed did. According to a report by Fortune, as of August 2023, the Fed had increased interest rates 11 times since 2022. The Fed doesn't seem to be backing down. If reports are anything to go by, they'd set a 2% inflation benchmark and will either maintain or increase the interest rate until they achieve their target. Cathie warns that it may be bad for you or the economy if deflation continues. And it's not only Cathie who thinks so. Many experts are alarmed about deflation. Shouldn't the reduced prices signal more purchasing power? Well, yeah, but it doesn't always work that way. Let's see why deflation isn't the best news since COVID-19. Number 1. Deflation promotes negative consumer behavior. Deflation changes consumer behavior and eventually harms the economy. I'll explain why. Imagine that the price of a mobile phone is reducing steadily. You can imagine that people will rush to the stores to buy it. But that won't happen. Instead of rushing to the stores, many people will postpone the purchases to a future date, hoping the prices will dip further. So in essence, consumer spending will reduce and businesses will not make many sales. Consequently, they'll lay off some staff and reduce costs further to break even. We'll be heading for a recession. Number 2, deflation can lead to a decline in aggregate demand. For starters, what's aggregate demand? It refers to the amount of goods and services wanted by the people. There are 4 ways: consumption, investment, net exports, and government spending. Remember, I mentioned earlier that as prices of goods and services fall, people would rather decide to buy later, hoping for a much cheaper bargain. So you'll have lower consumption, lower demand, higher savings, and capital accumulation. Now, that doesn't sound nice for the economy. I'm discussing reduced government spending, lower tax revenues, and higher debt burdens. And if the government tries to cut spending or increase its taxes, it will further reduce the aggregate demand. Then finally, there's the trade imbalances. We're going to have a situation where there's a dip in net exports. When there's deflation, your currency will climb in value. While that may sound like a good thing, in reality, it's bad for business. Exports will be more expensive due to a higher foreign exchange rate, while imports will become cheaper. Number 3, deflation leads to smaller profit margins. So what could get worse with all I've said so far? Well, Imagine your business not making as much money as it used to. Yep, your business's profit margins could dip due to deflation. Recall that I already said prices of goods reduce during a deflation. That's also because you may need to reduce your prices further to remain competitive. It would be challenging to break even, let alone register a profit. How will that happen when you still have to deal with production costs that may not fall as much as the prices of your goods and services? Let's not discuss businesses with fixed high costs or high debt levels. The truth is that while some businesses will make marginal profits, many more will shut down. Number 4. Deflation can cause high unemployment. If businesses are struggling to make profits while some are shutting down, one thing is likely: there will be job cuts. Your employees are part of your production costs, and you'd want to lay off some of them so that they increase your profit margin. So you have a situation where you have reduced demand for labor because many businesses may be unable to afford more employees since they intend to make a profit. I don't see how a business with a low profit margin will be interested in hiring a new person. Where are they going to get the money to pay them? In such situations, businesses are more interested in balancing their books and staying afloat. And then, when you consider that wages or payments may not fall as much as your prices, you even have a stronger argument for laying off some staff or not hiring new ones. The consequence of the scenario I've just painted is that there will be many unemployed people. That's a recipe for poverty. You can now see why Cathie Wood and many others are getting alarmed at the prospect of widespread deflation. It's just not good for our economy. We know the Fed is trying to lower inflation by raising interest rates, but they'll have to put the brakes on it at some point. Scott Horsley reported via NPR that all indications indicate that the Fed is probably done with raising interest rates. After raising the rates several times, the rates remained unchanged for the last week. Of course, the Fed is aware of the deflation in certain consumer goods, which means their strategy is working and is curbing inflation as intended. The decision to lower the interest rate is solely the Fed's. Fed Chairman Jerome Powell hinted that this would happen next year. However, some experts have predicted this would come sooner rather than later. A hedge fund manager, Bill Ackman, predicts that the Fed will start cutting interest rates as early as the first quarter of 2024. Bill believes that we'd risk a hard landing if the Fed doesn't cut interest rates as early as the first quarter. The consequences would require another set of policy measures to combat, so it's better prevented than managed. Thank you for watching this video. Can you remember when you purchased something cheaper than you do now? Can you recall how it affected your finances? I'd like to hear from you. Remember to drop a comment, hit the like button if you found this helpful, and subscribe for more eye-opener content like this. See you in the next video.